Hello, good afternoon. My name is Michael Coronado and I am with Pronto Advisors. And you are joining our webinar about mid-year tax planning and some things to consider, what to fix and before it's too late. Um, and we'll go over some examples, about 50,000 plus in savings, and we'll illustrate as we go along all the different things that you might want to adjust that may uh, improve your tax situation, and you want to take action before the end of the year. And that's kind of why we're doing this sort of at the just past the mid-year point, so that you have this in mind. I'll share a little bit about Pronto Advisors. We've been in business for over 35 years. We started our life as Pronto Income Tax. We are located in South Florida, but we have clients all the way from Miami to Alaska. So we service the entire United States. We also have clients in the Americas who own and operate businesses in the United States. We are an accounting and tax advisory firm, and we're here to help you and your business grow. And we're here to help you actually have a good understanding of your financial aspects of your business so that you can make the right decisions, because you have the right information at the right time in order to do so. I'm going to cover real quickly our agenda for today as introduction and tax year recap. Kind of went through that a little bit just now. We're going to go through our withholding and estimated tax check. So if you're a W-2 employee, or if you own a business and also receive a W-2 form from your business, so you're on payroll, you want to maybe make some changes or some adjustments. Now's the time to look into these things and possibly make some adjustments. There's some retirement contribution gaps, and especially if you're a small business owner, some things that you could do there. We'll talk a little bit about tax loss harvesting and capital gains. Lots of opportunities there as well. If you know you're going to have a capital gain this year, how can you take advantage of some other paper losses that you have now in order to offset those capital gains? And we'll talk a little bit about that. We'll also talk about the business owner and self-employed fixes, so some things about that. There's also the 2026 tax law changes. There was a lot of stuff in the news towards the end of last year. You might have heard about the big beautiful bill. Some things went into effect last year, some things are in effect this year. So you want to understand what those things are and how they affect you particularly, and what things you should be doing throughout the remainder of 2026 in order to make adjustments and find yourself in a good place. And lastly, we'll talk about charitable giving and deduction strategies. And just like everything else, it's about making sure that you do these. Obviously, you want to have charitable contributions. You want to help the foundations and different organizations that you see fit, but you also want to necessarily maybe think about timing and when it makes sense to do those in the current tax year, when it makes sense to push those into the next tax year, or maybe pull forward the ones that the contributions that you were considering for the following year. So it's just all about timing, strategy, and understanding how all of these elements work together and come together to help you save money on taxes. Ultimate goal here is not to make you a tax expert, but it's to make you aware of these different items. These are very general. This is not specific tax advice for anyone's particular situation. So please consult with your tax advisor, including us here at Pronto Advisors. So we're going to talk about payroll, and we're going to talk about withholding an estimated tax check. Well, now is a good time to kind of look at your paycheck. And why do you want to take a look at your paycheck? Well, because the IRS has some rules about, and you have this big number, the 7%, the IRS underpayment penalty rate. So you don't want to give money away, right? You don't want to pay more taxes than you need to, but you want to make sure that you're paying the taxes when you need to in order to not run afoul of this. And there's this penalty that, if you underestimate your tax withholding and are paying it when you file your tax return. So you didn't make estimated payments, you did not have the tax withheld from your paycheck. Well, guess what? The IRS is going to penalize you for this to the tune of about 7%. So you want to make sure that now's a good time to go and look at your paycheck stub and say, what how much did I make last year? Did anything change for 2026? Am I going to make the same amount of money this year? Yes. Did I end up having to pay last year as a W-2 employee, or did I pay because of something else? Do I want to make an adjustment either to the withholding for me as a salaried employee, or do I want to make estimated payments? And you want to make those quarterly, right? So we're halfway through the year, so you should have already made 2 payments, and then now we're looking, and then you have 2 more payments that you can make. Again, there's small penalties based on when you make these payments, but it also you can make adjustments if you have taxable income that does not stay consistent throughout the year. So if you're just a W-2 employee and you make the same $5,000 in every paycheck, and you decide at the end of the year is when you're going to pay it, or you decide to make estimated payments later in the year, you will still be subject to a small penalty for those periods. However, if you had a special case where you sold an investment property, you didn't know that was going to happen, and so now you make an estimated tax payment when that happens, after the quarter that occurred. If it's happened, let's say in the second quarter, you would be making that payment now in order to not fall behind or run afoul of the timing. So if you're self-employed, this is, so I guess 2 things, right? One is if you're a W-2 employee only, strictly, and you want to make adjustments, now's the time to do that. If you have the same income you paid last year, let's make an adjustment so that you're having more deducted this year so that you pay less. Considering that no other tax strategy happens. If you're having too much deducted because you had a large refund and you'd rather get a smaller refund this year, you can also make that adjustment to have less taken out of every check. Inflation is impacting everyone, so having more money in your pocket every paycheck will be helpful. But now on the latter case, if you're self-employed, as a reminder, you need to make estimated tax payments. So if you're 1099 self-employed, if you have a flow-through income that requires you to pay taxes, you want to make that tax payment by September 15th in order to avoid that penalty. And which brings me into the next one. So how do you lower your tax liability? One of them is to lower your taxable income. And there's things that you need to do for thinking about older age. So you start thinking about retirement. So now if I lower my taxable income because I'm putting money into a retirement plan, I'm lowering my tax bill today, right, for a non-Roth, right? So this is for a tax deferred, so a standard 401k, SEP IRA, or IRA. You're doing that now with pre-tax money, so you're not paying the tax today, but you will pay money on that later on. So thinking about retirement contribution and gaps, if you're not hitting the limits, this is maybe your opportunity to consider doing so, right? If you're in a 401k, max limit is $24,500. If you can max it out, do it. You're going to save yourself some money on taxes. IRA, limit $7,500. Again, same thing. Now, if you're over 50, I should have called this out on the 401k, you have the ability to increase $8,000 additional. If you an IRA, an additional $1,100 if you're 50 plus. So this gives you the opportunity to do so. I'm going to skip over HSA because I think that one's going to surprise folks, and I'm going to talk about the SEP IRA, and that's if you own your own business. There's some opportunities for you to lower your tax bill by contributing to a SEP IRA. There's some percentage of your revenue, profit from the business, and percentage of your compensation, but up to $72,000, which I know sounds like a lot, but if you're have a great business and you're making 7-figure profit, this is maybe something to consider. Same thing, pay lower tax now, and you pay the tax when you bring the money out. Coming back to the third item on there, which is the HSA, which really surprises a lot of folks. Well, I don't know if a lot of folks know that health savings account, for those who don't have that, is for a high deductible health insurance plan. And with a high deductible health insurance plan, the business and yourself contribute money to this HSA account in order to pay your medical expenses to meet that high deductible. Well, what happens if you don't use that money? Well, I don't know if you remember from many years ago, there was a flexible savings account. It was a use it or lose it. So you had to estimate, which you never know. You never know what year you're going to go to an ER, what year you're going to need surgery. So you have to estimate what you think your expenses are going to be. This, you don't have to estimate. You are putting in this money. And if you use it, well, you had it there. That's what it's there for. If you don't use it, it rolls over. So what happens is, especially if you're a high income person, you're looking at this as another potential way to save for retirement, because as the money grows, this is available to you for non-medical expenses beyond retirement. So you're able to roll this over into a retirement vehicle later on. So it's something else to consider. Hey, I'm saving money on this taxes. Let's do that. Let's or I'm saving money on this income, right? I'm lowering my taxable income. I'm paying less taxes, and and this is the case. For illustration purposes, there's a lot of numbers on here, but it's just what's the tax savings, if you are at the 37% tax bracket of all of these things, right? SEP IRA, 37% of 72,000, 26,000. 401k, if you're doing a 24,000, you're saving 9,000. IRA, 2,700, and an HSA, another 1,600. So combined, this is over $40,000 just in retirement contributions, and things that one should consider as they are, looking at their overall tax strategy, and looking at then using that money for it to grow tax-free, right? Because these are tax-advantaged accounts that will grow tax-free, and you only then will have taxable income when you pull out the funds. Someone's going to ask, I'm sure, so I'm going to go ahead and answer it. Roth. Roth is different. Roth is, you say, I'm going to pay the tax now because I know what the tax is now, and I am going to let this money, I'm going to put this into this account, so a Roth 401k or a Roth IRA. I'm going to let this money grow tax-free. So everything, the growth, if I take that $24,000 and turn it into $24,500 and turn it into $245,000, I 10x it. I pay zero tax on that money because I paid the tax today. So it's kind of that pro and con of, do I pay the tax now and allow it to grow tax-free, or do I pay no tax now and then pay the tax once I receive distributions from those retirement accounts? Which leads us into, well, we have these investments and you have this gain, so now you're going to pay tax on these gains, and it's a different tax rate for capital gains, especially for long-term capital gains. Short-term are considered ordinary income, so your regular income, but long-term has a different rate structure. But what if I get offset because I have some losses? And that's what we're going to talk about next. It's tax loss harvesting, is this idea of, I am selling a property and I have a huge gain on this property for X reason. I bought it at a good time and now it's appreciated, and I now want to offset that with the sale of another capital asset. Could be stock, could be the same thing with stocks, where you have a loss. And so there's some rules and things, but basically if you're at the 37% tax bracket and you are taking a $10,000 loss against the gain that you had, you're basically wiping that gain away and saving yourself 37%. So $3,700. For those of you keeping track at home, we're at $43,800 in savings so far, and I haven't even gone through the entire deck. And these are just basic tax strategies that most folks can take advantage of. So why do I say this? Well, let's say you were you were invested in one of the IPOs this year, like SpaceX, and you made money, or you held on and now you're losing money. So now's an opportunity to say, well, I sold this stock at a gain. Let me sell this stock where I have a loss, and so that you could then have that deduction you could lower the total income, your total capital gains based on that fact, as long as it was again for long-term gain. But the same thing for short-term gain, right? Long-term gains, actually, there's a better strategies, or sorry, there's a better tax rate, and as I kind of have highlighted up on the top, if you are a single filer, you have the first $49,450 you pay zero tax on a long-term capital gain, which is amazing. If you're married, you get double that, so $98,900. So it's a huge benefit. Beyond that, up to $545,000, you pay 15%, and then beyond that, you pay 20%. So it's also a stepped taxable, but this income is counted separately for those long-term gains. So something else to consider when these things are happening. One of the other things is, especially when it comes to real estate, think about your cost basis when you have real estate. Recently worked with someone where they sold an investment property. Well, throughout the years, they spent X number of dollars of things that were not added to the depreciation, that were renovations, that were increases to the value of the home, that increased their cash basis, their cost basis, right, for the home. So now instead of paying tax on the full amount between what they bought it and what they sold it, they now have something to offset that and lower their gain and pay less tax, or potentially fall into the category where they pay no tax because they were under $98,900 for a case of a married couple. All of these things are important, and as I've mentioned, everything else, is it really important to do these things today or in this tax year? Because what happens once the clock strikes midnight on December 31st and you're in the next calendar year, and considering if you are for an individual, you are at a tax basis, you are a calendar tax year, you cannot no longer have that loss. If you have that loss in 2027, it does you no good to go back to 2026 for the most part, right? There are some exceptions. The other thing is, as I'm talking about this, and I think sometimes folks miss out, especially if they've changed working with different tax advisors throughout the years, there are losses that you may have not been able to realize, net operating losses that you may have had from prior years that you were unable to realize throughout the history, that you need to keep track of. Because now if you have this gain, you want to take this prior year loss that was disallowed for X reason, because of passive activity or whatever the case may be, and bring it into this year when you have a taxable event. So something to keep in mind, so when people say, how long should you keep your tax returns? And people, 5 years, 7 years. I say forever, but that's me. But because that's one of those things, especially if you're not in the industry, it's not something that you are necessarily thinking about or cognizant of, and it's something that I think catches people off guard as they're kind of going through this. So, we talked a little bit about, if you're an employee or you're an employee of your own business. We talked about retirement's ideas for business owners were included in there. We talked about capital gains. I sold something, I made money, and now I have to pay a gain on this capital, the money I invested, that money I take out, it increased, it's more. But now what happens if you're a business owner? We're gonna kind of jump into that as well. Well, we talked about some of them, right? We talked about the SEP IRA, right? We talked about the SEP IRA contributions and how that's affected, and and actually this brings up one thing. I said, this is you have until January 1st. I said with some exceptions, this is one. IRAs are you can deduct and pay into up until the tax filing deadline, which is April 15th. So here's an example of something that's doesn't follow the general rule of thumb of the calendar year, but there are few and far between beyond that. Now you're a business owner, you've maxed out your SEP IRA based 25% of your income. Let's say you pay yourself $200,000, so you're putting in $50,000. That's great. You're saving yourself some money there. But you could also, depending on the type of business, you have a QBI deduction. So if you have which is allows you to write off the qualified business income up to 20% of it. And there's categories that are eligible. So definitely you have to review with the eligibility, income thresholds. There's a bunch of other different characteristics that you need to consider. And so that's something for you to possibly talk with a tax advisor as well about, to make sure that if they aren't already doing it, and you'll see it's a separate form on your tax return, then you should be having that conversation of, should we be doing this qualified business income? Does my profession qualify for it? And then we talk about, well, home office deduction. Well, work from home, pandemic, but even then, small business owners or business owners in general, even non-small business owners, they have a space dedicated to working. And so we'll talk a little bit about home office deduction. Excuse me. And the home office deduction is basically allows you to grab a portion of the space that you use. And there's some rules. This is the one that some people are a little concerned about, but it's about $5 per square foot up to 300 square feet. And you have to have a space that is regular and exclusive use for home office. What does that mean? That means it cannot be a bedroom. That means it cannot be a rumpus room. It cannot be a playroom. It cannot be anything other than an office space. And it needs to be dedicated for that. And you must be using it regularly. If you own a business, 99% certain you have a space that you're doing that in, but it can't be the kitchen table. It needs to be a separate, distinct space that's regular and exclusive use. And it's something that the IRS takes seriously, and also allows them the opportunity to, if you're still in the same place, to come in and inspect the space and make sure that there isn't a sofa bed or a rollaway bed or something that would make it qualify as a non-office use. So you have a business, you've got 3 other things that we could look at, and we'll talk about that. Business mileage on your vehicle, we'll talk about bonus depreciation, and we'll talk about health insurance. Well, what does that look like? Well, we've got business vehicle mileage. The rate actually went up this year, so halfway through the year it increased. I think it's 76.5 cents, but it started at 72.5 cents for the first half of the year, and then 76.5 cents. So if you use your vehicle for business, or if you have a vehicle that's dedicated for business, right? You have a work truck and it's only used for business. You can take off as a deduction the business mileage. What does the IRS require that everyone misses? And I have it here. I have log every trip. Well, not everyone logs every trip. Thankfully, we don't have to go back to what we used to do, which was have a mileage log or a calendar. There's now a lot of electronic tools that allow you to do that. In fact, I think there's some things you can even install, devices you can install in the vehicle that will log all of the miles. So it's the start mile, end mile, start address, end address, and then it's up to you to just log the business purpose of that, right? So Home Depot went to pick up supplies, X address went to do a service for a client, etc. So the IRS here is really looking to make sure, this is an easy win for the IRS if you don't have this log. And so I think it's really important, and I'm going to harp on this. If you are considering if you have a business vehicle mileage, a business used vehicle, you have mileage, you have a log, you got to document this. You got to have it ready. You have to do this contemporaneously. You cannot come back when you get audited 3 years later and produce this. You must have done this while things were ongoing. And I think that's something that trips up people and is an easy win in an audit for the IRS, but it's you could take the power back on that by just taking steps today to document these things. Next, we'll talk about depreciation, which is basically saying I've spent money on an asset, right? I bought a vehicle, I bought this business tool, and I'm not able to take a deduction 100% the first year, generally, right? But now there's these 2 mechanisms that allow you to accelerate these things, right? There's a section 179 in the bonus depreciation. And the bonus depreciation, which was being phased out, went back up to 100%. So what does this mean? This means that you can, if it's advantageous to you, right? And I think that's the big one, right, for all of these things. If it's advantageous to you, decide to take that in year one. Because here's what happens. If you eventually think of eventually selling that asset, the appreciation on that asset will you have to add to that the amount that you took away as a bonus depreciation. So if it increased, if you bought something for 100,000 and it's now worth 200,000 and you depreciated a portion of that 100%, let's say 30,000, you now have a gain of 130,000, not 100,000. So it's something to consider in your overall tax plan of how you do these things. Of do you take this bonus depreciation year one, month one, or do you wait and just have it done over 5 years, right? And a little asterisk here, if you own real estate, you might have heard about cost segregation studies. They're extremely popular. Well, same thing there. Does it make sense to do a cost segregation study and do these things now? Because the other thing on a cost segregation study is that you're offsetting, especially if you're trying to do this to offset your ordinary income. In the future, when you recapture the bonus depreciation on what you did cost segregation, it will go against your ordinary income, which is your work wages, right? Which can go up to 37%. If you saw earlier in the capital gains, it's only 20%. So you're now giving an extra 17% potentially, depending on the amount of money that we're talking about. So it's something just to be taken into consideration for long-term planning, so that you're not shooting yourself in the foot by taking advantage of something now to lower a tax bill that's just going to mean more money for you in the future. Lastly, if you are a small business owner, self-employed, you have health insurance deduction, so you can deduct 100% of that for yourself, spouse, and dependents. And that's a great way to lower your tax burden. And health insurance is expensive, and it's necessary. You don't want to get caught going to the ER without emergency room and want to be in the hospital, or some, heaven forbid, a serious illness without the health insurance. So having health insurance is really the way to do this. And now you can deduct it as a business expense, which I think is wonderful as well. Kind of coming back to the individual for non-business owners. If you own a home, you still have a mortgage, you pay property taxes, good chance that you're going to be beyond what is a standard deduction. And in the standard deduction, the IRS basically says, hey, everyone has something to deduct, and instead of you having to prove it, we'll give you this much if you're single, this much if you're head of household, this much if you're married, as automatic. It's a gimme. But if you own a home, you're paying mortgage interest, you're paying property taxes, you are potentially going beyond that just with those two things, which then gives rise to charitable giving. So as an individual, you can look at charitable giving and deduction strategies. So you can look at, hey, I've got the standard deduction, right? For 2026, $16,100 and $32,200 for your married filing joint. If your property taxes and the interest you're paying on your mortgage are over $32,200, then your charitable giving comes into play to be able to offset some of your income. So if you have a house, and let's say you're thinking of selling the house or paying off your mortgage and no longer being qualifying for this in 2027, you might start thinking about this idea of taking items that you were going to donate in subsequent years in 2027 and say, maybe I pull that into 2026 because I'm going to sell the home and I will no longer have this deduction, so that I can add to my mortgage interest, property tax, and now my donation can now add up and be beyond the standard deduction and provide me a real benefit in 2026. Same could be said for the opposite. You don't own a home this year and you're thinking and you're probably going to buy a home next year. Well, hold off till January 1st for that donation, because potentially that will move the needle for you in 2027. Aside from that, there's different strategies for donor-advised funds. If you want to donate into a donor-advised fund, and you're at the 37% tax rate, you're saving $18,500 on $50,000. It's another great example. I think with that, we're like way beyond the $50,000. I think we're at over $60,000 in what we've talked about in tax savings just on these particular items. So, donor-advised fund, you save some money. Bunching up contributions into one tax year will also move the needle further. And then lastly, we'll talk about qualified charitable distribution. So we talked earlier about IRAs, and lots of folks know after a certain age, 7.5, you need to make required minimum distributions. And when you do so, it's a percentage of the total asset, and you can decide, I don't want that money because I'm going to pay tax on it. I'm going to go ahead and make this into a charitable distribution, and it's also excluded from your income. So it counts towards your required minimum distribution, but it also counts towards the required minimum distribution, but it also is non-taxable because of the donation side. So it's a win-win in terms of what you could do and how you could take advantage. I'm going to take a minute now to run through and talk a little bit about the tax law changes, the big beautiful bill. There are lots of changes, so we'll have two different parts. We'll start with the state and local tax. We'll talk about tips, and we'll talk about overtime. So, SALT, if you haven't heard that, that's probably an industry term. I know I hate acronyms myself, but that's state and local tax. So what happened before, and if you notice I was talking about standard deduction, right? State and local tax was not. So that meant that your property was not open. It was limited. And so if you had a property tax beyond $10,000, you could only deduct the first $10,000. Well, that increased to $40,000. So if your property taxes are $20,000 and you're paying another $20,000 in mortgage interest, you have $40,000 of a deduction that you could take, which is above the $32,900, I think is, or $32,200, sorry, for married filing joint. So you have that opportunity. So that cap from $10,000 went to $40,000. It also helps folks who are in states that have personal income tax. We're in Florida. Florida does not have a state income tax for individuals, and so we wouldn't have that. But for folks in like New York and California, they are now able to take advantage of deducting those, which previously there wasn't a cap. So we've kind of gone back and forth, no cap, a higher cap, and we don't know what the future brings, but this is where we are today. The next one was one that started last year, and I will say of all of the deductions that I saw from folks, this was the one where I think people really benefited because there was $25,000 in tips that went tax-free. And so if you, you're probably at a lower tax rate, but at 15%, that's $3,750 in tax savings. That's in your pocket. So she had a young lady who was a bartender, $50,000 plus in income, over $25,000 in tips, $25,000 that she didn't have to pay tax on. Those $3,750 in her pocket. And this is through 2028. Don't know what the future brings, but for 2026, 27, and 28, for right now, you can continue to take advantage of that, and that's something that's part of your planning. So kind of tying this back to our W-4, talking about our payroll calculator, this is something where you say, well, gee, maybe I should lower a little bit if I'm now in a tippable position, a position where I could receive tips. And so I'm now a tipped employee, I guess, and so now I could maybe lower how much because my overall tax liability is going to be lower. And I think kind of tying it even more so, when you tell your employer, deduct this from my paycheck, you sign a W-4, you tell them this is how much I want you to deduct more, deduct less, you are basically saying this is what I think I'm going to owe, and it's your responsibility to be close enough so that when you file your taxes, you're not responsible for that penalty, that 7% we talked about early on. So that's kind of how all of these things kind of combine together. It's a lot of little moving pieces, and that's why I always recommend you talk to a tax advisor who's going to help guide you through these things. But a lot of these things are just come together for you, or come together to form your overall tax plan. Because ultimately, when you have a tax plan, and even if you're just a W-2 employee and you're like, oh, I don't have anything complicated, your plan should be, I'm going to make this much money, I'm going to pay this much tax, and when I do my taxes, I'm either going to pay, not pay, or get this refund, right? So you should have a plan, an idea. It should be within that expectation, so that when you get to that moment, and it's April, you're in January, February, March, you're filing your taxes. Hopefully you're not waiting until April 15th, right? And you're filing your taxes, or you file an extension and you file your taxes in July. That's fine as well. You're within what you expected, and you're setting these expectations because you have this plan in place for that. The last one on here is overtime deduction. And overtime deduction was one where I think a lot of folks were really, really excited about, but I really didn't see it move the needle in 2025, and I don't know if it's going to move the needle in following years. There was also some confusion because in 2025, your employer did not need to report that on their W-2. It was optional since it was a last-minute add, but in 2026, they must put it on the W-2. And just so you know, if you're making time and a half, the time, the one is still the one, so 100% still gets taxed. It's the 50%, the half. Or if you do holiday pay and you get double, it's still the one. If it was the standard pay is where you would still pay tax. It's the additional you're not. So if you're receiving $20 an hour, your time and a half. Simple example is $30 an hour. The $10 an hour you'd pay no tax. The $20 an hour you would still pay tax. So it's a misnomer because a lot of folks thought 100% of the overtime. It's like, no, it's just the time. It's the half, not the time and a half. That is tax free. There's some other stuff we'll talk about: senior deduction, auto loan, and 1099 reporting threshold. I'm most excited about the third one, so but I'll leave you in suspense. Senior deduction started last year as an additional $6,000 for taxpayers age 65 plus. So, I'm 65 and plus, but my spouse is not. Doesn't matter. You'll only get that one. If both are over 65, they add up, so they'll be additive. So it's another $12,000, and this is on top of either your standard deduction or your atomized deduction. So it's super, super useful, and I saw that really helping and move the needle for folks over 65. And I think those are folks who are really impacted by inflation. So I was happy to see that worked well in 25, and it's going to continue in 26. The other is about the auto loan interest. There's up to $10,000 in interest on loans for new U.S. assembled vehicles. How do they know? They're going to ask you for the VIN number. They will validate that this was a U.S. assembled vehicle. So if you have the sticker price, that manufacturer sticker price on your vehicle, and it has that information, I would save that as your proof for the future. And we'll also need like the VIN number for that, so that then the money that you paid in interest to the bank, you will be able to deduct on your personal tax return, right? Which is new. That's not something, if you weren't running a business or were not self-employed, that was not something that you could previously do. So this is a good one. And then finally, my favorite, and that I'm most excited about, is about the 1099 reporting threshold. That $600 limit had been there for a number of years. I actually forgot how long ago. It went from $500 to $600. I want to say 15 years ago, 10, 20 years ago. Feels like it was a really long time ago. Maybe it was less, but 10, 15 years ago, and it stayed stuck there. So if you paid someone or if you received income less than $600, it was not reported on a 1099, or over 600 it was. Well, starting this year, they've increased that threshold to $2,000. So you had a small side gig or something where you were not paid over $2,000. You will not receive a 1099 this year for that income. So I think that is amazing, because that was really burdensome, I think, more for the businesses, and then it's also burdensome for the folks receiving it. A lot of people don't realize when you are self-employed, you pay 100% of the Social Security and Medicare. So that adds another 15% to whatever your tax bracket is. So if you're at 37%, you're paying 15%. You're at 53% tax. It becomes extremely cumbersome. But even if you're in a lower tax, you're at 15, and you add another 15, that's 30%. It doubled the amount of tax that you were due. So I think that that's something really important, really great. I think I really want to shift gears and talk a little bit about a quick gut check. And so I think you know your situation best, and hey, last year was not the same or is different. I don't know what's going on. I don't really have an understanding. I feel like I'm paying too much tax. I feel like there's other things that I should take opportunity. Hey, Michael, you talked about these wonderful things. So if your numbers aren't, if you don't have that gut check of what I'm expecting is what's happening, that's where you need to go talk to a tax advisor. I hope you come talk to me and talk to us, and we'd be happy to talk to you about that. But I think that that's really the most important part. I think it's having this clear idea of where you're headed. Then if you have a business, how profitable are we this year? If you don't have these clear idea of the numbers, that's really where you have to start having the conversations of what am I, where am I headed this year? If your current, folks, advisors are not working with you on that, that's something I think that's really important, because without that, you can't make decisions, right? Because sometimes the decision is to do nothing, which is okay, status quo, continue. But sometimes you need to maybe make some changes. You look at, and then you look at, well, our profits are up. Are we overpaying in taxes? Are there opportunities like some of the ones that we discussed here? And there's still quite a few. I only scratch the surface of things that are available out there for yourself or for your business. There are things about expenses. Can the expenses be optimized to improve profits? Can expenses be optimized that are providing a tax benefit that we wouldn't have otherwise thought about? What makes sense for that? Do we have this information on an ongoing basis? Do we have this monthly? Do we have this weekly? Do we have this quarterly? How often do we need to be looking at this? I mean, I have a pulse. I see things, but I really want to have some ongoing reporting. And then, are we ready for upcoming filings? Like, if you have no idea, like, hey, in Florida, the sales tax just passed for monthly and quarterly filings, and so were you ready? Did you have the information and the data that you needed in order to have those filings? If you don't, then that's something to consider, and that's how we help. That's what we do. We work with businesses, with business owners. We help you stay organized year round. I think a lot of folks sometimes think, oh, it's compliance, I got to do taxes. Like, there's more than that, because you need to run your business. You need that accounting support, that financial support, that outsourced financial controller, CFO, that will provide you the information that you need to make the decisions in a timely fashion, right? What's the accounting support for this? What's the payroll? Are we doing the right stuff for payroll? Are we doing the stuff for tax planning? Are we looking at financial reporting? And then any of the back office things, right? Do we need help with accounts payable and accounts receivable and things like that? Those are all things that myself and the team at Pronto Advisors can assist folks with. And with that, we arrived at the point where I could drink a little bit of water and take a 2-second breather while folks submit any questions that they may have. Or Mira, I don't know if you have if you're able to pipe in and share questions that folks have had up to this point on the live, things that maybe went unanswered, but happy to answer questions. And I probably should have started that at the beginning. If you had questions, please send them through. You can still do so. Happy to answer. All right. I think if I was listening to this and I came across this, the question I would have is, do I need to do something? And I think that's something individual, right? You need to look at stuff and say, do I need to do something? Right? Am I unhappy or suspect that maybe there's a better way to do it? Then that's what you would maybe do. That's what you would look at doing here, and that or having a question for, or I would start questioning and start down the path of working with someone to work through these things. I would also, if I'm a business owner, and I don't have a clear idea of where we are and maybe where we're headed financially, I think that's a time where you start thinking, should we be looking at maybe some additional support? Maybe we have a day-to-day bookkeeper in office, but we need someone who's going to be providing more of that financial guidance. And that's something I did touch on here because I talked a lot about tax, but we also offer a Financial 360. So if you are a business owner and you want to have a better understanding of where your business is today and where it's headed and what adjustments you could potentially make, that's where we come in to give you a sort of, here's where you are, and these are the opportunities of things that you can improve, and then take that to then improve the financial reporting, the controls in your organization, so that then you have better visibility, better data, more timely data, and then you use that data in order to make decisions. And that's a Financial 360, and that's extremely useful. I see someone was asking, yes, there will be a link. Amira will put the link for if you'd like to schedule a consultation. Happy to work with you. Find a time and we can have a conversation and see if it makes sense for us to engage and assist you. Awesome. Well, before you go, here's your mid-year action checklist. I think I see it. Mira sent out the. Here's the mid-year action checklist. I thought there was another question. So run the IRS withholding tax estimator and adjust your W-4 if needed. Just kind of look at your paycheck stub, see how much you've put in thus far, and make any adjustments based on how your income has changed, increased or decreased, and how it looks like for the rest of the year. Look at how you're doing for your contributions, 401k, IRA, and HSA. Make any adjustments. Now's the time. Just start thinking about that. You don't want to hold that off till the end of the year. Again, I know the IRA you have till April 15th, but if you could, do that slowly throughout the year, it's probably in your best interest. Review taxable investment accounts. See if there's any opportunities from tax loss harvesting. If you're a business owner or self-employed, make sure you make your Q3 estimated tax payment in 2 months. So I guess we're a little ahead. So on September 15th, evaluate charitable donations. Make considerations around that and how you're going to do that. If you have required minimum distributions, maybe wait and make those donations when you are forced to take the required minimum distributions. So that either a tax advantage for you, so you're still helping the charity, but also saving yourself some money. And schedule a mid-year review with your tax advisor. That's what we do with a lot of our business clients as well. We offer a mid-year review where we look at their business, see what opportunities there are, and then make adjustments.